Hi there. If you're a personal trainer or sports coach, let's explore common business expense deductions and important UK record-keeping requirements.
Imagine dropping 850 pounds on high-end technical gym wear. You wear it exclusively for client sessions, never on the weekends, never for your own workouts. Then HMRC knocks on your door for an audit and strikes the entire claim from your tax return. If you operate as a self-employed personal trainer or sports coach, especially one navigating a highly competitive mixed-use market like Milton Keynes, bringing in 30 to 60,000 pounds a year, this scenario is a very real threat. Fitness professionals attract intense scrutiny from tax inspectors because the tools of the trade look exactly like lifestyle purchases, and the stakes are rising. With the recent shift making cash basis accounting the default standard and the 2026-27 mileage rate increases taking effect, filing an accurate return requires absolute precision. A single misunderstanding of how HMRC categorizes these costs turns what you thought was a clever tax saving into an expensive, highly stressful compliance audit. To protect your business, we need to start with the expenses that are reliably safe to claim. These are the undeniable operational costs required to keep your doors open. Physical space hire is entirely deductible. Whether you hold a fixed monthly lease for a private studio or you pay a local leisure center an hourly rate to train clients on their floor, the cost of accessing that space reduces your taxable profit. The same applies to mandatory protections. Commercial gyms almost universally require independent trainers to hold at least £5 million in public liability insurance. That premium, along with your professional indemnity cover and annual disclosure and barring service checks, are all fully allowable. When you fill out the full SA 103F tax return, your studio rent and liability insurance map directly into Box 21. Your DBS checks and subscriptions drop right into Box 30. Categorizing these foundational expenses correctly secures your baseline profitability and insulates your business from basic compliance errors. But that certainty disappears when we look at the most heavily scrutinized gray area in the fitness industry, your workwear. To claim an expense, it must meet the legal threshold of being incurred wholly and exclusively for your trade. HMRC enforces this using a strict test called the duality of purpose principle. This principle stems from a 1983 House of Lords case involving a barrister. She tried to claim a tax deduction for plain black clothing she bought specifically to wear in court. The court ruled against her, deciding that the clothing also provided physical warmth and human decency. That ruling directly targets our trainer with the 850-pound gymwear claim. Because plain sportswear provides that same basic warmth and decency, it serves a dual personal purpose. HMRC will disallow it entirely. There is a narrow exception. If you spend £180 having polo shirts printed with a permanent, non-detachable business logo, that qualifies as a true uniform. The branding proves it exists solely for the business. Your professional intent does not matter to a tax inspector. If a garment could theoretically be worn to the supermarket, it fails the duality of purpose test and cannot be claimed. That exact same strictness applies to our next major area of confusion, professional qualifications and your physical training equipment. HMRC views your initial Level 2 or Level 3 personal training certifications as a capital cost to prepare for a trade, making them non-deductible. However, ongoing Level 4 CPD, like first aid renewals, maintains existing skills and counts as an allowable revenue expense. As for the physical gear, the kettlebells, TRX bands, and client heart rate monitors, the new default cash basis accounting rules allow you to write off these purchases immediately in the year you pay the supplier. But there is a catch. If you use those kettlebells or bands for your own personal workouts outside of client sessions, you must calculate that personal usage and proportionally reduce your financial deduction. Attempting to write off your foundational entry-level qualification or failing to apportion the personal use of your gym equipment will trigger an immediate penalty during an audit. With those daily operational traps navigated, we need to address the 2026-2027 regulatory updates that will change your quarterly reporting requirements. For the first time in 15 years, the government has increased the approved mileage allowance payment for business travel. This chart illustrates the change. The flat rate deduction has jumped from 45 to 55 pence per mile, applied to your first 10,000 business miles. But securing that higher deduction requires precise data. You must maintain a contemporaneous digital mileage log, detailing the date, exact start and end locations, and the specific business purpose for every single journey. That level of digital accuracy is no longer optional. Under the Making Tax Digital mandate, trainers earning over £50,000 face strict digital record-keeping requirements starting in April 2026, with the threshold dropping to £30,000 in 2027. Finally, review your actual employment status. If a single commercial gym dictates your uniform, mandates your hours, and controls your client schedule, you risk being reclassified as an employee, instantly wiping out these self-employment deductions. The transition to quarterly digital reporting makes manual, end-of-year record-keeping obsolete. Staying compliant requires digital precision, strict expense categorization, and a clear understanding of the specific rules that govern your trade.